vice versa. So simple check here. What do you understand by risk management? Let's start from there. Then we build and continue building.
I would say generally, as the name implies, risk management. We are actually managing risks. So, but as regards forex, foreign exchange, is like managing risks regarding foreign exchange transactions, because we know the volatility
Mm-hmm.
in the market. So there are ways we can maybe reduce the exposure of some kind of risks as regards forex transactions.
Hello?
Did you hear what I said? Sorry.
I lost you as regards.
No, I said it's basically reducing the exposure of forex transaction. There are a lot of background noises, so the way I will say it in my notes.
Is it me or you? Like you mean the background noise on your side?
Yes, it's from my side. That's why I'm saying some
So
words, like I'm
the
just summarizing it. Yeah. So it's just
way
basically
okay.
reducing exposure of forex transactions between companies, especially companies
Mm,
that deals with international transactions.
okay. So in I think that's a fair definition. In financial reporting or in financial management, we have major types of risk management: foreign exchange risk management and interest rate risk management. Foreign exchange risk management looks at the risk attached to foreign currency transactions, meaning that having to make payment across boundaries, while interest rate risk management have to do with the risk attached to interest rates of borrowing or investing. Because practical example in Nigeria now, to collect a loan is almost like suicide mission because exchange rates are very high. So if you are to borrow a loan today in Nigeria, you might be scared that the next NPR government will come up with a decision to increase the NPR rates, and an increase in NPR rates will lead to an increase in the borrowing rate of your loans. So it is expedient that people now begin to look out for how they can manage the risk attached to their business. So, well, for today, we will be focusing solely on risk management or foreign exchange risk management and how they can be managed. So, with that, we start up our slide. So, foreign exchange management focuses on three major aspects: forecasting exchange rates, the risk attached to exchange rates, and the strategies to be used in managing these four or these different kinds of risk. So we have step one, which is forecasting exchange rates. So we have the interest rate parity model and purchasing parity model. In the interest rate parity model, we look at the difference in the interest rates can be used to estimate what we or you can use to estimate the exchange rate in the future. So that's the interest rate parity model. Why the purchasing power parity model looks at the impact of difference of inflation between two or more or between two economies and how it impacts the exchange rate. So you can see in this diagram on my screen, they are interwoven. because the interest rate parity model leads to, or it feeds on interest rates, and based on the future effects, you can get your difference in or your future exchange rate. Then with the purchasing parity model, the expected difference in inflation rates can be used to estimate the expected change in spot rates in future and vice versa. So it is a way of managing your risk in future based on current market realities. So for the purchasing power parity for a model, you look at the absolute purchasing power parity, which is the exchange reflects different cost of living in two countries. Meaning it shows you the cost of items in country A and country B. Then you begin to interpolate and find out what form of relationship exists between both. Then this relationship can now be used to estimate our future exchange rates. Then the relative purchasing parity model is measure the changes in market exchange rates that is caused by the difference in the rate of inflation in different countries. So they both work on the same formula. The formula is the expected spot rate, which is the 1 year time, is a function of your today's spot rate multiplied by 1 plus the variable spot rate, which is the spot rate of the alternative country or economy, divided by 1 plus the inflation rate of the home country or the base currency. Let me put it in a more meaningful sense. If we want to measure the exchange rate of the naira to the dollar, you say what is the exchange rate 1 naira to $1? Multiply by the impact of 1 plus inflation rate in dollars terms divided by 1 plus inflation rate in naira terms. Does that make sense before I go ahead?
I mean, yes, it does.
Good. So with this, we understand that the difference between the inflation rate in both parties will help you estimate what you expect to see as our future exchange rates. So example one, it said the spot rate on January 1, 20x6 is $1.9 per pound. So the dollar is the variable currency and the euro is the base currency. Why is this so? Because our rate is quoted dollar per pound, meaning that the amount of dollar you get in exchange for a specific amount of pound, which is £1. So, simple question. Most times, students, like in Nigeria now, we have our exchange rate at let's say an estimate average of 1,530. That rate is naira per dollar. So I know most times in my experience with students, they always try to say they think it is as naira per dollar. No, it is showing you how many, how much is your naira worth compared to $1. And in this sense, you are seeing the dollar as the base currency because in that formula, it is $1 that is equal to 1,530 naira. If you want to see the equivalent of 1 naira to a dollar, you will now do $1 divided by 1,550. Then you will now be getting approximately 0.0006 dollar per naira. Does that make sense? So the point I'm trying to drive here is the fact that whichever currency is the one that is stipulated as one, that's the base currency. Can I go ahead?
Yes, you can.
So let's solve this question. So I would solve an Excel file, and I would expect you to solve the second one. So we are both working together. Like I said, my classes, I prefer classes to be interactive. I don't just come and talk and go. I solve, you solve, I talk, you talk, and we are both involved in the class. So, permit me a minute. Let me share. Let me move my slide from my PowerPoint to my Excel. But for now, my Excel file is opening. So just give me a minute, let it load. But by the way, let's go continue reading the question further. It said spot rates on 1st of January 20x6 is $1.9 per pound. So the dollar is the variable currency and the pound is the base currency. Predicted inflation rates for 2006 and 2007 are as follows. In the
I think you're having network. I can't
US,
hear you. I can barely hear you. There is network issues. Hello, is anyone there?
yes, I'm here.
I can't hear you. I lost you at some point.
Sorry, I was asking which of the inflation rates is the base inflation rate, the US or the UK?
The UK.
Why the UK?
Mm, because of it's the question is saying pounds the base currency, dollar is a variable currency, and because
Mm-hmm.
of the power 1 pound, so that power 1 pounds, anything power one, um,
Okay,
is
so you are saying, so if I hear you clearly, you are saying the question is saying dollar per pound. So pound is the measuring currency, which makes it the base currency, and pound is the currency of the UK. So UK is the base country. Is that what you're trying to say?
yes, that's what I'm trying to say.
Okay, good. That's actually perfect. I just wanted to ensure you had an understanding of what we are doing before we go ahead. Okay, so my Excel file is coming up. Let me swap my screen to my Excel, then we solve. It's time where you can see my Excel file.
Yes, I can.
Okay, so relative purchasing power parity. Remember, our formula is stated as simple as this: expected exchange rate. So X1 is equal to SO multiplied by, no, multiplied by 1 plus interest rate of foreign currency or foreign country, then divided by 1 plus interest rate of base country. Good. So in this case, we have it to be simply this. Our spot rate today is 1.9. So before we get there, let's some headers to our discussion. As at 31st December 2026 or 2006. No. 31st December 20x6. So expected our expected spot rate would be the current spot rate multiplied by 1 plus.
I can't see your Excel
Uh,
anymore.
can you see it?
No.
What's on your screen? Please tell me.
The normal Zoom, the way Zoom is, my name, your name, and every other person's.
Oh, sorry, my screen stopped sharing. I don't know why it stopped sharing. Let me share back. Maybe you can see it now.
Yes, I can.
Good. So our expected spot rate will simply be this. What is current spot rate? Current spot rate is 1.9 multiplied by open brackets. I like open two brackets. 1 plus the counter country. In this case, our counter country is the US at 2%. The US at 2%. So 1 plus 2% divided by open brackets 1 plus the inflation rate of UK, which is 3%. So this is the expected rate for 20x6. So if we are to get expected rate for 20x7 for 20x7, please can you walk me through what we're meant to do?
It's as if you stop sharing our screen, if I'm correct.
I okay. I don't know why it stops. This one stops sharing by itself. It's weird. So can you see it now?
Yes, I can.
So 20x7 is for you to solve. So walk me through what you'd do if you get my shoes. How do you compute the expected exchange rate in 20x7?
And that will be 1.86.
1.86. How did you
Yes.
get 1.86?
The expected spot rate for 20 X7. We use the spot rate for December spot rate, which is 1.88, then inflate it with 1.02 by 1.03.
If I hear you clearly, you are using this is what you're saying. Let
I'm
me
using
solve what you just said.
the spot rate of
That we computed,
1.88.
right?
I didn't get you.
The spot rate that we computed.
The spot rate is,
Yes,
I'm
ma'am.
using the current, that's the one you just saw, 1.88 will be the current spot rate
Okay.
for 28.
Okay. Times open bracket 1 plus 2%, 1 plus 3%. This is what you mean?
Mm. Yes,
Yeah, sure.
yes.
Hey, 1.86. That's wonderful. So with this, we say, okay, we have good understanding of how purchasing power parity was. So let's go back to our slide and we continue. So what we solved is correct. So let me show you the answers. So slides. We got 1.88 and we got 1.86, which is the expected rate. So now we move on to interest rate parity. For interest rate parity, it is the same process, but rather than using inflation rates, you are working with um, interest rates. So you are saying, what is the forecasted interest rate for the future? So what's the forecasted exchange rate based on movement in interest rates? Does that make sense?
Yes, it does. Hello?
Yes, ma'am. Yeah. So
I said yes,
it
yes.
means yes. So it means we are basically using the same formula to get the new or estimated exchange rate for the future. So same for the exchange rate multiplied by spotted variable rates divided by the base rates. So in this case, we have the same numbers which will invariably give us the same or different movements. So we had solved for activity one. For activity
Sorry,
two, I would expect it.
can I ask you a question?
Yes, ma'am. Please go ahead.
Please go back to the last slide. The last slide.
I moved back. Yes, I did.
Can you please explain that last statement? If IRP did not hold, risk-free profits using covered interest rate arbitrage could be made. What does it
If
mean?
interest rate parity did not hold, risk-free profits using covered interest arbitrage could be made. What it means that if the station or the expected movement in exchange rates does not materialize, people could profit from borrowing in one currency and going to invest in another currency. That is arbitrage. Let me give you practical example. There was a time where in Nigeria, before we floated an naira, our official rate was different from our black market rate or market rates, right? Hello?
Okay, yes, yes, I can hear you.
Yes. So at that point, people could easily get money from the banks and sell it in the open market to get a gain.
Again,
That gain is what we call arbitrage. So on the flip side, If official interest rate is different from market interest rates, or there is difference in interest rates from estimated as actual, people could gain a profit based on buying from one side and going to sell on the other side. That is the arbitrage. Does that make sense?
Okay, it makes sense. Is there a case where they actually set questions as regards this statement?
For AFM, no. The AFM is way too advanced to set. It might come as part of the notes, but a full-on question, I don't think so. It's very unlikely.
Okay, can go ahead.
Okay. So, activity two, your turn. Please solve this question for us. Let's move on. Can you read it?
Hmm?
Can you read the
Oh, okay.
question?
Spot rates January 2016 1.9 per 1 pound. So here is the dollar is a variable. So yeah, the dollar is a variable currency and pounds is the base. Do you want to read activity two? I'm actually reading activity one.
Yes. Activity two. Yes. No, activity two. You've done
Okay.
activity one now.
If
The first
if
question we
the
did.
spot if the spot is 1.7 per dollar and the dollar and sterling interest rates
Okay.
3.25 and 4.5 respectively. What is the 1 year forward exchange? So basically, anything base currency is also called sterling interest rate, right?
Sorry, say it again.
So those base currency that's base interest rate is also called sterling interest rate. I mean.
No. The base interest rate is the interest rate of the home country. What does this mean? It is the interest rate of the currency that is stipulated as one.
That's the
So it
base.
is, yes, it is just a coincidence in this question that our pound is the base currency in both of them. And I can easily attribute it to the fact that ACCA is UK based, so they always speak from the perspective of UK. If I should say, if spot rate is 1.78 pounds per dollar, the dollar
Mm.
in that case is our base currency.
Okay, but I'm
Base
seeing the
currencies,
dollar. Sorry, I'm seeing the dollar and the sterling interest rate. So the dollar
uh,
interest rate is 3.25. What is that
yes,
sterling
ma.
interest rate?
Is the pound sterling?
Okay, sterling is pound. Oh, okay, now I
Yes,
get it.
pound
So
sterling.
sterling.
Sorry, pound sterling is the full name.
Okay,
Just
okay.
like we
That
have the
was like
Nigeria, like our currency is actually the Nigerian naira.
that was my confusion.
Oh,
I
okay,
thought
okay.
okay. All right. You
So
want
you
me to
thought you
solve
thought
it?
you thought pound. Yes, ma. Please do. I like interactive
Okay.
class. So I allow people solve. I just only be solving.
So I actually thought that sterling was something else.
No, it's not. It's pound.
Okay. That should be 1.758. That's one point seven
One
six.
point 1.76.
Mm.
Okay. The dollar. So let me take a wide guess. The dollar rate is 3.25 and the pound is 4.5. So the pound has a higher interest rate. So definitely the exchange rate will go in favor of the dollar. So let's see. 1.76. Yes, you are correct. Makes sense?
Okay.
So we go ahead now. The international fixture effect is portrait will change to offset nominal interest rate difference between both currencies, and the expectation theory speaks to the future where forward rate is an unbiased estimate of future spot rate. It is just a way of you measuring how you expect movement of interest rates to go in future. Does that make sense?
Okay.
So we have solved part one of our topic. We are moving on to part two. Types of risk. We have translation risk, economic risk, and transaction risk. But as a person, I like starting from transaction risk to translation, then to economic. So, what are transaction risk? These are short-term risk that affect the value of transactions, meaning that it is the risk that the value of the transaction will change from the day of initiation to the day of settlement. Does that make sense?
Okay. It does.
Hello? So
Yes, it
meaning the day they invoice you for a commodity, and normally uh, purchases are majorly on credit. So when they invoice you, you might have a 30 days or 60-day payment period. So the risk that the rates might change between day of invoicing and day of payment
payment.
is the
Okay, that's
transaction risk. Hello,
okay.
ma, what did you say?
No, I'm actually echoing what you're saying.
Okay. So if the rate goes against you, you would pay more. If the rate goes in your favor, you will pay less as compared to the date you posted the invoice. Generally invoices are posted using the rate as at the day they were invoiced, right?
Hmm. Yes.
So you will not have to book an exchange gain or loss as at settlement. Now
Okay.
that is transaction risk. Then step two is translation risk. Translation risk is the risk that assets or liabilities denominated in a foreign currency might change in value due to changes in the risk. So changes in the exchange rate. This may not necessarily be a cash flow item like transaction risk, but the cash flow impact would crystallize at settlement, either extinguishment of the liability or disposal of the assets. Now, it means that book-wise, there might be a gap in the size of your asset or liability based on movement in exchange rates. Practical example. When we floated the exchange rate in Nigeria, most companies with dollar-denominated loans had to revalue their loans from the official rate as at then to the new rate, and they all booked exchange losses. Does that make sense?
Yes, it does.
Good. So you agree that exchange losses doesn't mean that money has been spent immediately.
Hmm.
It just means that okay, oh, this is the new value of your liability, and this is what it is valued at today. That
Okay, if I
difference
understand
would
you
only
perfectly.
okay,
Sorry, if I understand you perfectly, there is no like a movement of cash as regards
not yet.
translation rate. As regards translation rate, so basically it just affects the like the P and L accounts.
Yes.
through gain or losses, right? Then that transaction risk, it affects cash flow because of receivable and
It is
payables.
settled. It's exactly settled immediately. So
So
for
transaction risk,
translation risk, it, I'm listening to
sorry,
you.
for transaction risk, it affects, let's just say it affects the balance sheet because of payables and receivables, right? And
Yeah.
cash. Then translation risks basically affects the P&L account through gain and losses, through maybe
It
assets and
also
liabilities.
affects the balance sheet because the value of asset or liability will change.
We change.
But
Okay.
the difference is that for transaction risk, it has a cash impact now because transaction risk is a short-term risk that would have to be settled immediately, meaning that your invoices would have to be paid now or you will receive that receivable now. Make sense? But for your translation risk, it would only crystallize in the future because that loan might take a number of years before it settles complete, before you finish liquidating it. So step by step, your the cash amount you're meant to pay would only be physically incurred when settling the debts, even though you are gaining recognizing the loss today. Does that make sense?
Okay.
Good. Then the last one is economic risk. Economic risk is the risk that the value of a company or a business will change due to long-term change in exchange rates.
Okay.
Does that make sense?
Yeah.
Now, transaction risk can be hedged, translation risk can be hedged, but things like economic risk are hard to be hedged because we don't really have long-term hedging instruments for to suffice economic risk. What do I mean? For transaction risk, like my previous place of work, we had a clause in our contracts where we said that if exchange rates does not move by more than 5%, we will pay at the rates of the invoice date. It means that if exchange rate moves by 5%, that 5% loss, we would not incur it because we had put in a particular clause in our contracts and we have hedged that risk. Does that make sense?
Okay.
Good. Another way of hedging transaction risk is by using hedging instruments like forward swaps, features, and options. Then for your translation risk, this can be hedged by ensuring you match assets and liabilities in the same currencies. Meaning,
Okay.
if you borrow money in dollars, ensure your receivables or your investment are also in dollars, or your cash transactions are in dollars. In this manner, if exchange rate is going up, your loan is going up, but your investment value is also going up too. Does that make sense?
Yeah, it does. So basically, translation risk is you edge it by doing that matching of asset and liability with one currency, abi?
Yes, in the same currency.
Then what else?
Sure.
After matching it in the same currency, what's the next step? Is it you not easy
The,
to get the gain
the,
and
ju-
loss, abi?
no, what it does is that any gain or loss in one part is materially reduced by gain or loss in the second part. meaning a gain in your assets would use to cover for a loss in your liability.
Liability, okay.
So,
So,
like I said,
mm-hmm.
if your receivables is in dollars and you have loan in dollars, as your loan value is increasing, when you also review your receivables balances, you'd post exchange gain.
Okay. Okay. This makes sense.
Hello, let me go on.
Yes, we can.
Okay, good. So your question, I think you're asking a question then.
I don't have any question. You answered the question.
Okay. So I was saying economic risk is a risk that the size of the country would, oh, sorry, not country, company would change significantly due to sustained movement in the exchange rates. Does that make sense? So, for example, now, if you had invested $1 million in Nigeria, you converted it to Naira and used it to buy shares in Nigeria in 2010, there is a very high chance that no matter how profitable those shares are, if you convert it back to dollar today, it might not even be up to the initial capital you invested in Nigeria. Does that make sense?
Yes, it does.
That is economic risk. So if you are a US based nation with operations in Nigeria, the Nigeria subsidiary can be making or having increase in profit year on year in naira terms. But when you are consolidating, the performance will be falling year on year due to the constant depreciation of the naira. Does that make sense?
Can you repeat that again? Sorry.
I said if you are an American company with a subsidiary here in Nigeria, if your subsidiary in Nigeria is having increase in profit year on year, that means every year their revenue is increasing, their profit is increasing. There is a possibility that due to, especially for the last 3 years, it's a possibility that the performance on the global level of that company would be a reverse of the naira performance due to the impact of our exchange rate. What do I mean? At the end of 2022, exchange rate was 460, official rates. Then at the end of 2023, it fell to 889. So whatever assets you had as of 2022, without doing anything, you have lost half of the value. Now, let me put that into another perspective. It means even if you had doubled the size of your business, having 100% double in your performance in 1 year, you have only tried just achieved to maintain status quo in dollar terms. Then in 2024, even if you do another double performance, which is very massive jump, you would only just be maintaining your USD equivalent or having a slight increase. Why? Because our exchange rate fell from 260 to 899 to 15. Does that make sense? That
Yeah,
is the
it makes
econ.
sense. Okay. I wanted to ask a question. In that case, like for example, based on this your analysis, and you were asked in the exam that what do you advise the company to do as a finance officer? What's the best response? Because regardless of what performance that Nigeria company will do, regardless, the value of the company will still be in adverse condition.
So it is exactly what I have on my next slide. You can do one of the following. One, you can attempt to ensure that you finance the business in Naira and have all its operations in Naira. So you are comparing Naira for Naira and not dollar for Naira. That's one. You can invest in other countries. So the fall in the value of Naira would be hedged by the rise in the value of other currencies. Does that make sense? So the fact that Naira is falling, like practical example now, we know for a fact that the Ghanaian cedis has gained value tremendously in recent times. So if you invested in Nigeria and in Ghana, as the value of your Naira transactions are falling, on the other hand, the value of your Ghanaian transactions are increasing. So you are holding a diversified portfolio. Does that make sense? Hello?
So basically, diversification can reduce such exposures.
Yes, because you are not faced solely to the risk of one exchange rate.
It makes sense. Mm.
You could also increase the price of your products.
But if you are doing that, it will have an adverse effect because you are pushing that price to consumers.
Yes, there's exactly. Then the question is how. So if you are looking about increasing pricing, you would also consider the elasticity of your demand. For example, now, practical example, here I would guess you are here with me in Lagos. So here in Lagos we have two major suppliers of electricity, which is Ikeja Electric and Eco Electric, right? So wherever you live, you cannot wake up one day and say, okay, I want to change from Ikeja Electric to Eco Electric. It's almost not possible except you change your accommodation. Meaning you move to an area that is supplied by Eco Electric. So for Eco Electric, they can easily push the costs of increased electricity by increasing tariff plan or costs to their customers because they have very inelastic supply demand for their goods. Customers cannot readily change from them to somewhere else. Does that make sense?
Yeah, it does.
Then on the flip side, if you want to take a ride from your house to the office, I'm sure, like, assuming you don't have a car, you open Uber, you open Taxify, you open Bolt, you open InDrive. You always compare the four prices of the price of these four apps. You now compare it to the last most important one, public transport, which is our downfall and commercial vehicles. Whichever is the cheapest or the most convenient is what you will take. So you could take Uber today and tomorrow you take InDrive, next tomorrow you Trek, and the fourth day you will take Downfall, and you'll be fine. So you see, for the supply of electricity, they can easily push their costs to their customers because they have an inelastic supply. For your commuting between locations, it will be very hard for them to push because even if you get to the bus stop and say want to enter public transport, if the first bus is calling the price 100 naira more than what you are used to, you say no and you enter the next bus because you can easily make that decision. Does that make sense?
Yeah, it does.
Okay, so now we now go to how do we manage exchange rate risk in a company. So we have two ways: internal management of exchange rate risk and external management of exchange rate risk. So for the internal management, we have invoicing your domestic country currency. We have leading and lagging. We have netting, matching, then asset or liability management. So let me explain one by one. First one is invoicing in your domestic currency. What does this mean? I am based here in Nigeria. My customers are in Ghana. I don't know what's happening between Nigerian Naira and Ghanaian cedis. I don't want to be a party to it. So I tell my customers, pay me in Naira or find another supplier. So that way, if my invoice is showing me 1 million Naira, I know no matter what happens, I am receiving 1 million Naira at the end of the 30 days or 60 days credit period I gave my supplier, my customers. Does that make sense? So that way you have eliminated your exchange rate risk. Pay me in my local currency. That way you are not faced by what is exchange rate saying, what is exchange rate not saying. Two, leading and lagging. What does this mean? Leading means making payments earlier than expected in order to enjoy current exchange rates and avoid depreciation of exchange rates in future. For example, we are both ACCA. So I'm an ACCA member and ACCA student. If ACCA comes today and send an email to me and you that coming January 1, 2026, they are changing their exchange rate from let's assume 2002 it is now to 3,000 naira. You would agree with me that you would ensure you pay your subscription this year and you also fund your wallet with enough money to cover for your exam fees in future, right?
Yeah, it's obvious.
Exactly, because you say, let me enjoy this exchange rate before I hear stories that touch. So then on the flip side, if ACCA say, okay, we want to give discounts to our members, so we are subsidizing our exchange rates. From 2025, students will only pay 50% of the rates and will cover for the remaining 50%. I can guarantee you that we will all wait. No, it is next year we start paying for anything we are paying for. Why? Because we want to enjoy the new exchange rates that is going to be floated by CBN. Make sense?
Yes, it actually does.
Good. So that is the policy of leading and lagging. Leading is when you pay in advance. Lagging is where you delay payments to enjoy future changes in exchange rates. Sense? Can I go ahead? Can I go ahead? Hello, are you there?
Sorry, I didn't get the last one.
I said, can I go ahead?
Yes, please. Yes, please. There is noise
Okay.
in the background, so I may not all the time, but I can hear
No,
you.
no,
Especially
but
noise.
the truth is, Microsoft Teams have a noise cancellation effect. So that noise you are hearing, we can't hear it.
No, I mean there is noise in my own background, so I don't want it
Yes, I
to.
know. I am telling you
Okay,
that
okay.
Microsoft Teams has a noise cancellation effect. So it won't pick your background noise, but it will pick your voice. But that notwithstanding, we understand you. So let's go ahead. Netting is where you are deducting liabilities from assets to have a net position, meaning that you also deduct income from expenses to have a net cash flow. So I want to pay $1,000 to somebody and I'm expecting $800 from another customer. I just know that my only issue now is how to source for the difference of $200 because whenever that $800 come, that's what I'll use to pay for the difference in my I like that to pay for the outflow I'm expecting. Then matching also happens where you are trying to so netting and matching is very similar and most times it can be used interchangeably by students. But matching is where you are bringing assets and liabilities together to net them off. Then the last one is asset and liability management is where you're ensuring you have balance between asset and liabilities to ensure that you are in a favorable position at all time. Makes sense. Does that make sense? Hello? Can you hear me because you are quiet?
Yes, I can hear you. Sorry. So sorry if I may understand it. So that netting and matching is for it is used for hedging that translation risks, right?
Netting is for where you have so for netting where you have sales and purchases both in a foreign currency you offset the receivables and payables like I said I want to pay somebody $1,000 and I have somebody that wants to pay me $800. I know the only thing I should consider is how to hedge the remaining $200, right? Because once $800 come from this person, I use it immediately to cover the portion of the $1,000 that I have outstanding. Does that make sense?
What I'm trying to get is, when you were talking about that translation risks, transaction risks, and economic risks,
Mm-hmm.
and you said that those translation risks you use like netting and matching. So I'm just referencing it that mostly this netting and matching is for translation risks, right?
Okay, yeah.
No, I'm just like echoing it that it can be used
Yes,
majorly
yes,
to
is
edge,
for
to
exactly. So
reduce translation, like it's for
netting,
translation.
matching, and asset management for translation risk because
That
balances in both
invoice.
currencies are merged together.
Okay, then for invoicing in domestic currency and maybe leading and lagging could be for economic risk. Am I correct to
Transaction
say that?
risk. Transaction
Transaction
risk.
risk.
Yes, economic risk is the consistent impact of transaction risk.
You can go ahead.
Okay. So it's wonderful. We move on. Now, the question is, should company use external hedging methods?
Are you asking me a question?
Yes, ma'am.
What did you say?
It's on the screen.
Yes, companies should use external agent.
Why?
Hmm?
Why?
I guess I don't know, but I feel companies should also use external agent. I don't know. You are the teacher. Tell me.
I'm trying to get your opinion as a professional. So it's not about me being the teacher. It's about me getting feedback from my students. Just the more you think. It's not about it being right or wrong.
I feel internal aging cannot totally be used um reducing forex transactions risks in a way where um I really don't know, but I think I have an opinion, but I really don't know.
Tell me your opinion. Say it in pidgin. I understand. I understand pidgin too. Are you there?
Sorry, I was talking. I didn't know that my
You were
mic switched
muted.
off. Okay, I say there are possibility where I may want to pay transaction in the future, but I need to like because of the volatility in the exchange rate, nobody knows the future. So there are ways I could probably reduce such risks by going to the bank to make an agreement
Sorry?
kind of. I can actually reduce such risks of making a transaction, like pay money in the future by going to the bank to make an agreement with the bank by creating an exchange rate, maintaining an exchange rate that I can use to make such payment. And it's
Mm.
it, it relates basically to international transactions like between countries, two countries. So external agents, I feel it affects um those big countries like UK, US, and where you can't really. I know what I'm saying, but I can't really put it in words.
Yes, you're making perfect sense. So sincerely. Now,
Really,
let me
really.
let me pick what you said. You said yeah, you can go to the bank to agree a rate that you use to make payments in future, right? So you are not bothered about exchange rate because you already have an agreed rate with the bank. Should that what you said?
Yes, that's what I said because I'm not really bothered if there is changes, if there are volatility in the future. I'm really bothered
That
that at
is,
least that at least my payments
you
will be
have locked in a
secure.
particular rate.
Yeah, yeah. I'm using
That is the
I'm using a
exact
rate.
that is the
Hello.
exact definition of what we are discussing next.
So does it make sense what I just said?
I just said what you just explained now is the exact definition of what we are discussing next. Like that's practically my next slide.
Okay, that's the
Forward
reason for
exchange.
external edging, right?
Yes. Or no, that's
Okay.
one of the ways company hedge externally. I mean
Oh,
that you
okay.
just successfully defined one of the hedging instruments we use in external hedging.
Okay, all right, no problem. So now I'm passing the question to you. Why do we use external hedging?
External hedging is necessary, is useful, yes, and necessary because not all risk can be hedged internally. Because, for example, one, there are some transactions you cannot hedge, you cannot change the currency because you don't have bargaining power to change the currency. One, two, there are some where you don't have assets or like where you don't have corresponding asset or liability in that currency. You can't do things like netting, matching, or asset liability management, right? So, and for some contracts, it might be you losing more than gaining if you have to get into things like net leading or lagging, especially lagging. So the internal hedges instruments, they are quite limited in their efficiency. Does that make sense? Hello?
Yes, it does.
Good. So now we now have to consider the hedging strategies available to us of external hedging strategies. Number one is the forward. The forward is generally a predetermined rate by which you exchange your currencies at the future rates or at the future dates. You simply say that, okay, oh, I have agreed a rate to exchange this currency on this date. What it means is just like you have mentioned, it is basically saying we have a contract or an agreement in place that this is the rate by which we would sell or buy this currency. So it has already been cast in stone. Now, for characteristics of your forward hedging contract, it is most times it's customized, meaning that it is tailored to your exact need. There are no premium payable on this contract too, and physical delivery must occur, meaning that you must buy or sell that particular currency at the pre-agreed date. You can come and say, sorry, I'm not interested. I don't want to trade again. That the pre-agreed have to deliver. Does that make sense? Does that make sense?
So what now happen if, for example, after hedging something, like you've set a rate and hello, can you hear me?
Yes, man, I can hear you.
Okay, like you've set a rate now for, let's say, next year or next 3 months. And that next 3 months, the thing was now favorable. Like
Eh,
the market
you
rate
set
is
it, set it
now,
now.
huh?
You lose the benefit of the market rates.
So is it like, are you using the market rate or you are still using what you
Nope.
set already?
What you set.
So there's no possibility where you will not exercise the
Nope.
stuff.
Nope. That's why I said physical delivery must occur. You have signed it, you must fulfill it. If it is a forward agreement, you must fulfill it.
Okay,
You can't
if it is
walk away.
if it is forward agreement, okay, all right.
You must fulfill it. We will get to where you have the decision to walk away. So then we have something we call non-deliverable forward. What are non-deliverable forwards? They are short-term contracts and they are always cash settled between between two parties. What does this mean? It means that when we say non-deliverable, it means that you don't have to deliver cash to both parties. Rather, you deliver the gain or loss from both parties. Does that make sense?
Can you explain? I don't understand.
So, we said for our forwards, as we defined, that forwards has to physical delivery must occur, right?
Yes.
Do you remember? So,
Yeah.
for non-deliverable forwards, we are saying in non-deliverable forwards, the difference between the agreed rate and the market or spot rate, that is the gain or loss, that is what will be transferred. Meaning you don't have to deliver cash. So that is NDFs. Have to deliver cash. You only pay the difference between the agreed rate and the spot rate.
Okay. All right. Excellent. Can go ahead.
Okay, sorry, just means I think I have altered my screen. I don't know again. Okay, then we have the next hedging strategy, which is the money market hedging. For the money market hedging, it is a combination of borrowing in one currency and investing in another currency in a manner that you enjoy the benefits of current spot rates as well as the net gain or loss of difference in borrowing and investing rates. Does that make sense? Does that make sense?
We don't understand this one.
You don't understand this one?
So you are borrowing. Maybe a practical example will do, but I don't understand it. Borrow at fixed rates. Borrow.
This is what I mean. I will explain. Money market hedge is practical example. When you want to raise rents, right, in Nigeria, the average low income earner in Nigeria will do what we call isusu or ajo to raise money for rent or student school fees. So you are giving people money you are contributing money to people, and when it's your turn, you collect. In that way, you are trying to leverage on the collective financial capacity of every other person. So in this manner, we are trying to leverage on the exchange rate today and the interplay of the spots of the interest rates among the different currencies. What do I mean? You as a student, your ACCA subscription is in 4 months' time. So in that 4 months, the exchange rate might no longer be favorable. So you said, okay, let me buy the pounds today and enjoy the exchange rate today because pounds is in a good position. But that pounds you bought today, you cannot just go and put it in your ACCA wallet and it is doing nothing there. You say, okay, I have bought these pounds today. Let me go and invest it in the bank, right? So you go and buy um treasury bills in London money market and say, okay, 4 months treasury bills. So in 4 months' time, that is in January, that treasury bills will mature, then you liquidate it and use that money to pay your um subscription fees. Does that make sense?
It does.
Good. So that's the step. You say you borrow today at a fixed rate, and we are using the term borrow because we always know that every source of finance has a cost. So even though that money is coming out from your company operations, the fact that you have an existing work means that fund comes at a cost. So
Is there a way we can like solve a question so I can understand better?
you will, you will.
Okay.
Just
Okay.
want to get all the theory aspects out. Well, that is money market hedging. Then walk through activity 4. Let's read for me, then I'll solve.
For activity 3, right?
4.
For okay, a UK-based company expects to receive £300,000 in 3 months. Spot
Mhm.
rate dollar per um pounds 1.7818 to 1.7822. 1 year sterling interest rate is 4.7 borrowing, 4.6 investing in percentage.
Mhm.
1 year dollar sterling, 1 year dollar interest rate is 5.8, 5.4 borrowing, 5.1 investing in percentage. Set up a money market edge.
Okay, let's go to our Excel file.
Okay. Sorry, can I see the question again? Let me just write. I'm
Sorry,
actually writing it.
give me a minute, I'll share it back. I see it.
Okay, you can go to your Excel sheet.
So, market edge. Please, compare can see my exhaust slide.
Yes, I can. I can.
Okay, good, fantastic. So, We said we are to receive, let's go to the question. We are to receive 300,000
100,000
in
in
3 months'
3 months.
time.
Mm.
Receives $300,000 and duration.
3 months time.
Uh, so what are we going to do? Let's now define how money market hedge works. Because we are expecting to receive dollar in time, means that we want to ensure that the value of the pounds we are getting will not significantly change between now and 3 months, right?
Yes.
So that means let's determine our spot rates. So question for you, which of the spot rates are we meant to use in our computation? Is it the 7818 or 7822? So we have two exchange rates, 1.7818 and 1.7822. So this should have used.
Since we are dividing,
This
um,
is this is
we are going
USD.
to use 1 point. Since we are dividing, we are going to
uh,
use 1.7822.
1.78 watts.
Double two.
Why?
Um, the base currency is sterling, and we are receiving, meaning we want to get the higher spot rate since we are receiving. If we are buying, we'll use the lower spot rate.
Say that again.
I said since we are receiving 300, we'll prefer getting the higher spot rate. If we are buying it, we'll be using the lower spot rate.
If we are, so we are saying we should use 1.7822.
Yeah, 1.7822.
Okay, so do I agree? 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 I don't know. Let's find out. Because we are trying to sell the dollar to get the pound, we would have to sell at a higher rate, meaning we are giving more dollar to buy the pound. So yes, we are using 1.7822. Does that make sense?
Yeah, it does.
Good. So 1.7822.
It's as if your part is cracking. I can barely hear you.
Can you hear me now?
Yes, I can.
Okay. So this is the trick. This is the trick around money market hedge. You have to start from the back to walk to the front. This is what I mean. We want to receive, we want to receive $300, $1,000 in future, right? So you have to first of all determine how much You don't need to borrow in dollars today. That will be equivalent to $300,000 in 3 months' time. Does that make sense?
Yes, it does.
So the borrowing rate in dollars is 1 year dollar interest rate for borrowing is 5.4%. So we have to borrow 5.4% in 3 months. Borrow at 5.4% for a 3 month period.
Okay, but it's showing 1 year interest rates. Are we going to
Yes,
prorate or
yes, ma. So
sorry, are we
borrow,
prorating or we are using that 5.4 directly?
evaporating.
So we are prorating for 3 months, are we?
Yes, ma.
Okay.
So amount to amount to borrow in USD now. Will not be 300,000 divided by 1 plus open brackets 5.4% multiplied by what is our how many months? 3/12 by 3 divided by 12. So this is the amount of dollars you need to borrow now. Does that make sense?
Okay.
Let me explain what it means. No, just work with me. This is what it means. It means because we are going to receive dollars in 3 months' time. We need to
Okay.
ensure that we create a liability that will be equal to 300,000 in 3 months. So we borrow money today, but we cannot borrow $300,000 today because in 3 months' time, that $300,000 will have accrued interest, right? Do you agree?
Yes.
So you have to borrow an amount that would be directly equivalent to $300,000 in 3 months' time.
3 months time. Okay.
So
Okay.
you would say, okay, how much is the borrowing rate in USD? The borrowing rate is USD is 4.5%. So you use that 4.5% to discount your amount so that this 296, if we borrow 296,000 now, in 3 months' time, 296,000 plus the interest will now be equal to 300,000. Does that make sense?
Okay. Yeah, it does. So wait, I want to understand now. You are planning to receive money. You want to receive money in 3 months' time.
Yes,
So you are going
yes,
to borrow that money today, right?
yes,
From the bank.
yes,
But
yes.
my question is, why are you borrowing the money now since you are receiving it in 3 months time?
Because you want to utilize the exchange rates today.
Okay, today. Okay, 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 okay. Okay, it makes sense now. You can go ahead. So sorry, I may not say anything, but just continue. I'm with you.
So, The question now is, okay, now that we now know this is the amount we borrow today, now convert the USD to pounds today. Then this guy divided by this guy. So this guy divided by this guy. Do you agree?
So we are now converting it today dividing by that, yes. In pounds, right? So that currency will change to pounds
Yeah.
instead of dollar.
Yeah, I'm changing it to pounds.
Okay.
So this is how much that pounds is worth today. Now, remember, this money is expected to come in 3 months' time, right? So
Yes, yes.
we should invest the pounds for 3 months. So when the dollar comes, we are now liquidate. When the dollar comes, we now use dollar to pay the amount we borrowed, and we now liquidate this guy to get the pounds in that 3 months time. So we invest this guy, multiply by 1 plus bracket open. What is our investing rate in sterling? Investment in sterling is 4.6%. 4
Yeah,
points,
4.6% times
4.6% times 3/12.
3/12. Yeah.
So is what this is what will be the dollar equivalent in 3 months' time. So you see that if you are to convert this amount to dollar today, it will be worth 168,000. But because we have used money market hedge, we are now bringing it to 167,000. Why did the amount reduce? So let's do analysis. Why did the amount reduce? The amount reduced because the borrowing rate in dollar is higher than the investing rate in pounds. Do you agree?
Yes.
So the equivalent of the dollar you are getting will reduce. If the investing rate in if the investing rate in pounds was 7.6%, you see our money will jack up to 169. So
Okay.
this is market hedging. We usually do this where we are skeptical that exchange rates will move to an unfavorable position in future. So you rather enjoy the exchange rate today than wait for the future where it is no longer as good as today.
So sorry, what's the interpretation of this? So the answer basically is 167.9 in pounds.
Yes, it means that 300K we are receiving in 3 months' time, when we receive it, the pound equivalent will be 167,000 pounds, because that's the amount we have hedged it at.
So is this favorable or adverse?
Depends on how you want to interpret it. So you have to compare it, one, to other exchange and other hedging strategies, one, as well as other or the estimated exchange rates in 3 months' time. Does that make sense?
It does.
Any question?
No question. So in a way, the answer will
Yes,
always be in
ma'am.
pounds. In a way, the
Yes,
answer
ma'am.
will always be in pounds instead of dollars. Okay.
Answer is coming back to pounds because your home currency is pounds.
So okay.
If you are making a payment, remember you are hedging a currency from foreign to local.
Yes.
So it will always come back to your local currency. If it doesn't come back to your local currency, that means you have made a mistake.
It makes sense now.
Okay, let's go back to our Excel, PowerPoint slide. So this is practically what we just solved now. Everything here, and we are moving on to the next. Next one we have is options. An option is an example of derivative or hedging strategy that can be used for exchange rate risk management. It is defined in the following ways. An option is a right, not an obligation, meaning what is your right? You can decide to implement your right, or you can decide to overlook your rights. Do you agree?
So if you can decide to exercise the right to allow it to lapse. So in a way, what you just said is that this is different from forwards, Abby.
Forward. Yes. Forward,
Okay.
you are obligated to fulfill. For options, you are not obligated to fulfill. Rather, you can choose if you want to fulfill or not. That is why it is called a right.
All right. Makes sense.
Huh?
Yeah, it's okay. Mm-hmm.
Okay. Then we have two types of options, the call option and the put option. The call option is the option to buy, the put option is the option to sell. Does that make sense?
Yes. Hello, please
What's
give
your
me
question?
one moment. Please give me one moment, sorry. But you can continue teaching, just
I said we have two types of options, a call option or a put option. The call option is the option to buy, while the put option is the option to sell. Then, like explained earlier, for your options. You can exercise your rights or allow it to elapse. Allowing it to elapse means that you are walking away from the option. Then that right you have comes at a cost because that choice you have should not be cannot be free, not should not be free. So it's you have to pay to get that choice, and that payment is what we call the premium. That is the cost of the option. And options can be exchange traded or it can be OTC. What is an exchange traded option? An exchange traded option is an option that is available in the open market, meaning that it is traded among market participants without having to revert back to the original initiators of the transaction. Meanwhile, OTC option is between two market participants or a limited number of market participants. Therefore, it cannot be traded outside or without their involvement. Then we have the American style options and the European style options. American style options are options that can be exercised at any point in time, while the European style options are options that can only be exercised at the date of expiration or the date the option is elapsing. Remember, European options can only be exercised on the expiry date, while American style option can be exercised at any date up to the exercise or the expiry date.
Okay,
Makes
noted.
sense.
Yes.
Good. So let's move on. We have the next point of call, which is exchange options. So hedging with exchange traded options. So most times people always have these questions when I'm doing an exchange traded option. Should I which option am I buying or which option am I selling? Also, should they be call options or put options? Then the next question is what expiry date should my options have? Then how many options should I acquire? So these are all questions that are necessary to be answered for you to find an efficient hedging strategy. Any question?
No.
So, majorly options are always bought when you want to hedge a risk. It is where you are doing things like a collar that you sell an option. Majorly options are bought. Then, like I said, options can be put or call. A put option is an option to sell, a call option is an option to buy. Then, which expiry date should you use? It is always safe to say your option should be active more longer than your transaction date. Option should not expire before the transaction date. Then how many options should you buy? The options should be bought should be enough to cover the transaction amounts. However, there are times where you cannot have a perfect hedge, meaning that the number of contracts needed cannot be exact. It's either you're buying excess or you're buying shortage. You understand me?
Yes, I can.
So uh most times it is advised to on the hedge. So you could use other hedging instruments to cover the difference. Then what else have I not covered? I think I've covered then delta hedging. That is valuation of a hedge. This will come later on. Then activity 5, hedging with exchange traded options. We have data on February 4 for exchange traded options. The option is £31,250 on the options. Then in brackets, we have cents per dollar. What it means is this is the premium payable on the option. So we have three strike price 1.6, 1.610, 1.620. Then we have call options, we have put options.
So
Then
I
this is where the question.
I don't understand
Um,
when you said the premium. You said something about premium. I don't really understand. Is it that 31 is 31 250 is the premium?
is the contract size?
31 250 pounds is the contract size.
Yes, ma'am.
Okay.
Then the premium is that cents per dollars. So all this number you are seeing here, 1.8 is 2.77, 3.33, 2.69. Those are all premium payable on the option.
Oh, okay, okay.
Okay, then the question is on February 4, a UK exporter sells to a US customer for 300,000 receivable towards the end of April. Current spot rate is 16119 to a pound. Required. Show how this receipt should be hedged using currency options. Illustrate the outcome if the spot exchange rate on the date of receipt is 1625 and 1600. So simple. So this might most likely be our last solving for today before we draw the class to a close. So let's go to our Excel file. This is exchange traded options. So we have 3 options available in the question: 1.6, 1.61, and 1.62. So we need to answer the 5 different questions. First thing, what option are we buying? Are we buying the call option or the put option? So the contract is euro per pound, and we are trying to hedge a receipt. So it means that we need to buy the euro and sell the dollar. So euro per dollar, not euro per pound. Pound per dollar. Apologies. So we need to buy the pound and sell the dollar. Do you agree?
Yes.
So, so in this case, we will say, okay, to buy the pound, we would have to buy, when we're buying the pound, we are using this kind of options.
Is it we are using put option, right?
Why is it put option?
So I didn't write. I wasn't able to write the question
So we are
before
buying
that.
put option. So why is it put option?
I didn't say. I want. All I'm saying is that I wish I could see the question again.
Okay, I can show you the question once again. Can you see it?
Yes, I can. Sorry, let me just write. Just write one. Okay, I can go back to the question to your Excel sheet.
So, what
Okay,
kind of
since
options are we buying?
yeah, it's the put option because the UK exporter sells to US, so that selling is put.
Hmm?
Did you hear what I said? Sorry.
I didn't hear you.
I said the UK exporter sells to the US, so it's selling, so it's put option.
Yeah. So first thing we need to correct. An option is priced based on the currency of the option. What do I mean? The option is domiciled in pounds. So whatever you are doing would always be in regard to the pounds. So the question is, what are we doing to the pound?
The UK exporter sells this. So
Are we selling the pound? If yes, why? Are we buying the pound? If yes, why?
but the UK exporter is selling dollar instead of pound.
Hmm?
Hmm?
What do you say?
I said the UK exporter is selling dollars to US
Listen to,
customers.
listen, listen to what I said. The contract of the option is what is our pivot, meaning that the option is valued in pounds. So whatever you have to do, you have to think in relation to the pounds.
Oh, it's okay. Okay.
So
So the UK is buying pounds to sell to US.
in this case, we are buying the pound and selling dollar.
Uh,
Do you agree? Because we are receiving pounds, right? I know.
This buying pounds, is it regards to the
We
premium?
are receiving money. No, we are receiving money, right?
Yes.
So we have to sell that dollar to get the pounds, right?
Yes, to get the pounds.
So you need to buy that pound. So you need to ensure that whatever you are doing it in respect to the currency of the transaction, which is the option. We are making receipts, right? So we are having receipts. These receipts would have to be in line with the pounds. So we are receiving money, which is dollars. We will sell the dollars to buy the pounds because the pounds we need. If we are making payment of $300,000, we will be selling the pounds to buy the dollars. Does it make
Okay.
sense?
Yeah, it does.
So First step. So we are buying the call options. We are buying the call options because we are buying the pounds. Does that make sense?
Yeah.
So once we buy the call option, we now say, okay, let us test the three rates. So we have three rates strike or two different strike price. So strike price 1.6, 1.61, 1.62. Okay. So first things first, you calculate is at this exchange rate, what will be the pound equivalent? So pound receipt is 300. Sorry, dollar receipt, not pound receipt. Dollar receipt is $300,000. Do you agree?
Yeah.
So these are the different US dollar, and these are different pound equivalents that it can be, right?
Yeah.
So we will say, okay, and now let's add a caveat. This is a disclaimer, assuming we can buy partial contracts. So number of contracts will now be this guy divided by 31 to 50. Do you agree?
Yes.
So this is now contracts in hard coded numbers. Then once you have this number of contracts, the next thing you have to consider is the premium payable on these contracts.
Okay.
Because we are buying, we forgot to mention one thing. We forgot to determine the option we are buying. They said the question said that this delivery is towards the end of April. So obviously we are buying April options. So let's put it buy the April call options. So premium in USD. Premium is really simple. This guy is cents by per dollar, right? So multiply by what's the premium payable?
It's
First one is
31.
3.3.
Hmm. Big. Okay. 3.32.
3.3 divided by 100. Right, this is in cents, right? So the next one is multiplied by 3.3, 2.77. Then this one multiplied by 2.63. Then premium in pounds.
I don't
And spot
understand
rate is
that.
what?
That first one in USD, that's six
Hmm.
thousand. Is that currency in USD or pounds?
That first 6,000. So where do you see 6,000?
Premium in USD, I'm seeing 6,000 one. That
So
first one
is pound, is dollars,
is
sorry, dollars. Should be dollars, oh, should be dollars, mistake. Let me change it. I, I linked it to a pound cell. Otherwise, it's giving us dollars. So now let's put this guy. What is our exchange rate? Our exchange rate is 1.6119 by 1.6119.
you mean the
So
spot
this is
rate?
the pound. Yes, spot rate, spot rate, spot rate. Does that make sense? Are you following me up to here?
I got lost.
Where did you get lost? Tell me, let me find you.
That premium in USD, 6,000. From that 6,000.
Okay, so remember they said, go back to the question. General
No, I
options,
want to ask. I want to ask. Is that April call option? Is it in USD or pounds?
the premium is payable in USD.
No, what I'm saying is that those calls and puts, those figures that was listed 1.88, 2.7, so are those in USD or pounds?
Which one?
In the question, there are some figures under
Yes,
calls and so.
they
Those
are.
two,
Yeah, they are all in dollars.
they're all in dollars.
Actually, they are all
Hello?
in cents. Cents is yes,
So that figures are all in USD.
yes, but they are in cents. Cents is like the kobo of USD.
I mean the Kobo, yeah, I know. So those figures are like in USD.
Yes,
Then the pounds one, we now had to divide it by the spot rate, have you?
yes,
Are these the various step for options? Like you must do all this for options question.
yes.
It's not straightforward like forward.
Yeah, yeah, it is not.
Hmm. Okay, you can go ahead. You can go ahead.
Yes, ma'am. So you can see here that we have the period was in cents converted to dollars. So this is dollar equivalent. Then here that became pound equivalent. Then this is amount receivable. So because this amount, the net receivable, then the net receivable would be our amount receivable minus our premium paid. You agree? Are you there?
Sorry, at what point are we using 31 to 50?
Yeah.
Hmm?
Yeah.
I can't hear what you're saying.
We use it to determine the number of contracts. So here.
Oh, okay, wait. Sorry. Let me put your cursor in that amount receivable.
No, I know. I will put my cursor in it.
Are you there?
Yes, I have.
I'm not, amount receivable. Let me put your cursor in that
Amount is
18.5.
receivable. Okay. Okay, this is it. The dollar divided by the exchange rate. Divided by the strike rate.
No, amount receivable. Let me put your cursor in one of those amounts.
Wait, which column? Column B now, right?
Amount receivable. Yeah.
I just did.
Let me put the B30. B30. I want to know how you got those value. A47.
Which value?
Those amounts receivable. I want to know how you got the 185 something.
Dollar
So it's
received divided by strike price.
okay. What I'm saying is that at what point are we using 31?
I told you to determine the number of contracts.
Okay, to the number. Okay. Okay. All right.
That's why I said, assuming we can buy partial contracts. Because if we can't, we have a whole lot of extra process. But I do want to boggle you with that information now. So I want us to have just partial contracts and we go from there.
Okay. All right. Okay. You can move on.
Okay. So based on these three, which one do you think is the best option to pick and why?
Mm, I think it should be the first one because it gives the highest receipt.
Eh?
I think it's the first one because it gives the highest receipt.
Yeah. So we would determine that we will use option one as our recommended option.
Okay.
And back to our question. Question now is um, illustrate the outcome if the spot exchange on the date of receipt is 1625. So if our exchange rate becomes 1625, what should we do? And if our exchange rate is 1604, what should we do? Spot rates at 1.625 at 1.605. So these are the two options available to us. What do we do in this case?
Okay, so they want us to pick which one is better or what?
Uh-huh.
I'll pick the highest.
Which is
186915.
no, I said in each scenario, what should we do?
Um, should we like now I'm confused.
So remember, you are comparing these prices with these prices because the premium. Okay, no, let's like this. You are comparing these prices with these prices. Yeah, because the premium must be paid irrespective. What we're trying to understand is should we exercise our option or not? So in this case, so since we're choosing this option here, right? We would
I,
always
I feel
exercise our option.
I feel since that last one is higher. Okay, yes, we should because it's actually higher. What I'm saying is that since the one we actually took before, which is 187,500, because if you look at it, it's even more higher than this current spot risk value. So there's no need not of exercising it. We should just exercise it.
Exactly. So any question?
So in exam case scenario, we are supposed to follow this 1, 2, 3, 4, 5, 6, 7 steps, right?
In exam case scenario, there are extra steps. Remember, I assumed you can buy a partial contract. In exam cases, you might not have the potential to buy partial contracts. So
Right.
you
Okay. So when are we solving those exam case scenarios, Christian?
maybe when we are done with the theory part, we will solve an exam case scenario. So the last thing we have to touch today is the futures. We have 20 minutes. Let's quickly touch futures so we know we are coming back to solve an exam case scenario.
Okay.
So future is very similar to your forward. The
Okay.
only difference is futures are standardized contracts and they are majorly always traded. Does that make sense?
Okay. Okay.
So for a feature, it has, if you look at statistics, it is standardized, meaning that it has a fixed amount, which is the contract size. That's a fixed rate, which is the future price. That's a fixed date, which is the amount, the date the transaction would occur, and it is via a recognized exchange, meaning that it is exchange traded. Also, uh, also, futures have what we call margin requirements, meaning that you have the initial margin, the maintenance margin, and the variation margin. What are these three? The initial margin is the initial amount of money you deposit with the exchange when you are starting a contract.
So are you
It's a,
sharing your screen? I can't see anything.
yes, ma'am. I'm
I
sharing
can
my
see.
PowerPoint slide. Let's go, you can see it.
No, I can't. I can't see it.
Uh, I'm coming. Let me stop sharing and share again. I said,
Yes, I can see it now.
so can we go on?
Yes, we can. Okay.
Yes. So the slight difference between a future and a forward is the following. The future has a fixed amount, just like we see on the options. That's a fixed price, it's on a fixed date, and it is sold via a recognized exchange, meaning they are exchange traded. Then futures have margin requirements. What does this mean? It means the gains or losses on the transaction are posted daily to each participant.
Okay.
Let me explain. What is what we call initial margin? Initial margin is the initial deposit you make with the exchange when you are opening the contract.
Okay.
So, like when you're opening an account, you have to put money in the account for initial deposit. That's the amount you pay. Then maintenance margin is the lowest amount below which your balance in the with the exchange should not fall under. Then the variation margin is the extra amount you have to pay whenever your balance falls below your maintenance margin in order to bring you back to your maintenance margin. Does that make sense?
Yes.
Do you know how to differentiate the three of them?
Um, I think initial margin is like a lump sum, like a deposit. I feel it's similar to
Mm-hmm.
like paying a deposit. Then
Yes.
I think maintenance margin is um
Uh,
I think it's as the name implies, use it to maintain the account. Then variation margin. I really don't know the difference between maintenance, but I know one of them is, for example, if your deposit, like the money in that account is not using, you now need to put another money in so that you have like your account will be more liquid. I don't know if it makes sense in that direction.
as margin is the maintenance margin is the minimum your account.
I can't get
Margin
I can't I
changes
didn't hear
because
what
this
you
is
said.
the extra amount.
I didn't hear what you said the last
I
time.
said
What did you say?
initial margin is. I said initial. Can you hear me now?
Yes, I can hear you.
Hello. I said
Yes,
initial
I can.
margin is the initial deposit you make with the exchange. Maintenance margin is the minimum balance you should have in your wallet. While variation margin is the difference between your balance whenever it falls below the maintenance margin and the maintenance margin. So if your balance is 30,000 naira below the maintenance margin, your variation margin for that day becomes 30K. So they will call you and expect you to pay 30K to the exchange to close out your position.
Okay.
Does that make sense?
Yeah, I got. It does. It does.
Makes sense? Okay. So we move on to an example. So please help me read the question, then we solve. It's already solved this, we'll just walk through it.
Okay. Are you posting it? I can't see any question.
You can see my screen.
You okay? I can see it now. Um. So successive daily price on a 1 to 5,000 euro future contract, which have been sold at selling price 0.6916. Then day one 0.6930, day two 0.6944, day three 0.6940. Initial margin are £1,000 per contract. The maintenance margin is 100% of the, so that's 1,000. Then day one loss of 1 to 5 times 0.6930 minus this is equals to 1,000. Is this the solution? I don't understand.
No, so read up to day 3.
So I've read day three in which one? The two of them.
No, just in the first one.
Okay, I've read it. Day three 0.6940. Initial margin are £1,000 per contract. The maintenance margin is 100% of
Okay.
initial margin.
Okay. So successful daily prices on a 125,000 euro future contract have been sold. Selling price is pounds per euro 16 is 0.6916. Then day one, it moves to 0.6930. So what you see is that your price has moved from 0.6930 from 6190 to 6130. So in day one, you're making a loss, which is 0.0014. Then you multiply it by this value of your contract, which is 125,000. You now have 175 pounds. That is the amount of what is this 175 pounds now?
I think
Hello?
this loss, the loss, right?
Which yes.
Hello? Hello, I can't hear you.
Yes, ma'am.
I can't hear you. There's network issue.
I asked, can you hear me?
Yes, I can hear you now. It's cracking. It's not clear.
So I said the 1,000 euro is the initial margin, right? That is the deposit you make. Then said the maintenance margin is 100% of the initial margin. So that means your maintenance margin is equal to £8,000. So if you're having a loss of 175, that means your wallet balance is now lower than your maintenance margin. So the £175 is your variation margin that it will be posted to your wallet. Does that make sense?
Yes.
Hmm? So for day two, you had another loss again of the same 14 ticks, which is a tick is the smallest movement in value of a share. So or value of an derivative. So in day two, you have the same amount of loss, which is £175 you have to pay. And day three, you had a profit of £50. You don't have to pay for the profit. Meanwhile, the profit is yours. So the profit will be posted to your wallet. Does that make sense?
Yes.
Good. Then, like I said earlier, what is a tick size is the minimum price movement of future contracts. It is the smallest movement of your contract. So it is computed by multiplying your size of the contract by the duration of the contract. And sorry, my mouse is stuck somewhere. I'm trying to find my mouse. So for like an example here, for a contract that is 65,000, that is 0.01% of your contract size. So what else? Yes, locking rate is the adjusted rates between the date of you exercising, or the date of the transaction date and the expedition of the contract. This always happens where you are where your contract does the expression of a contract does not align with the transaction date. So all this will become more useful to you in our next class, where we'll solve a full question. The final to look at is comparison between futures and forwards. So for the major difference between these two is simple. Credit risk for forwards is credit risk exists because it's between two parties. But for a future, is credit risk is eliminated because it is between a party and the exchange system or the exchange market. So you would need some form of guarantee by a bank for a forward, but for a guarantee because it's with the market. The size of a forward is always whatever size you want, whatever date you want. So far, you both agree. Meanwhile, for a future, is always standardized. For your forwards, it has no margin requirement, but your futures has margin requirements, meaning this market to market. And for forward, physical delivery is required, especially when I'm buying cash. But for futures, you post the net gain or loss. Basis exists in futures because of you have to look at the market movement. Meanwhile, for forwards, basis does not exist because the contract terminates at the agreed date between and party. Then for the forward, cash flow happens on the last day, which is date of delivery. Even for futures, cash flow happens on the daily basis. And for your costs, it is always based on client relationship between you and the bank, while for a future, it is more transparent. Any question before we wrap up this class?
No,
Hello?
I don't have any question.
Yeah. So we are going to solve a full question in our next class. With that, I tell you thank you for listening to my class. Hope you learned many things today.
Nice. Thank you very much for your class.
See you in our next class. Bye bye.
Okay. Bye.